Global debt is soaring, and public debt is a huge burden on economic growth. A lot of people are saying that nothing is happening because of this accumulation of debt. However, we have three major burdens on economic growth and three limits that we should be exceedingly worried about. What we can see in this graph, courtesy of Bloomberg, is the IMF projections of debt, global public debt. And what we can see is not only that it's been rising very, very fast in a period of economic growth when it should have been coming down. What we are seeing also is that it's likely to accelerate further into 2050 if the current fiscal policy remains. This is very, very dangerous because of the three limits of public debt that we are mentioning. Number one, the economic limit. More public debt does not generate further growth in productivity growth, support for investment, or real wage improvement. Actually, it works as an enormous burden, an enormous weight on the economy. Number two, the fiscal limit. The fiscal limit is enormous because in more and more countries all over the world, what we are seeing is that the cost of borrowing and the interest expense are both rising despite central banks cutting rates and despite the allegedly benign environment of monetary policy. Therefore, interest expenses are starting to be one of the major elements in budgets, destroying the ability of governments to find fiscal space. Number three is the inflationary limit. More debt means more inflation in the future, means more taxes in the future, and means worse real wages. So, the other element that we're seeing is that this level of excessive debt, of excessive public debt, is generating those three limits, and those three have been completely exceeded: the economic, fiscal, and inflationary limit. Let's go to the next graph and see what we can get further out of it. We have just mentioned the economic limit. This graph, courtesy of JP Morgan, shows how the impact of global public debt and the impact of these completely insane fiscal policies is very evident as well in capital expenditure. Productive investment is plummeting. Productive investment is plummeting, and this means that productivity growth in the future is likely to be very, very weak. And this is something that we should be worried about because governments should not be concerned about bloating GDP and jobs figures with public debt and with government spending. They should be concerned about the importance of strengthening the environment for productive investment. And productive investment doesn't go up when investors and when companies are seeing in the future more taxes, persistent inflation, and weaker economic growth. Let's go to the next graph, which also shows us a very important factor, which is how this completely irrational government spending frenzy that we are seeing in so many economies is actually not delivering any level of growth. The European Union, which was supposed to be the poster child of public stimulus packages in the middle of the next generation EU, is not just not growing at the level seen prior to the pandemic, but way lower. China obviously is in a period of lowering its growth, but at least it is not implementing completely insane government spending packages. But emerging markets ex-China are also growing below the trend seen prior to the pandemic. And this is exceedingly worrying because of what we can see in the other part of the graph, courtesy of JP Morgan, is that the level of deficit spending is out of control, that governments are simply spending like there's no tomorrow. Let's go to the next graph and we can see the impact of this disaster. The inflationary pressures remain. Look at this. the energy base effect has been the major driver of the reduction in inflation. However, now geopolitical risks and different aspects of monetary policy with rate cuts are leading to a bottom in energy prices. Be very careful. This graph, courtesy of Bloomberg, shows that the inflation impact is likely to be negative once the base effect is over. Let's go to the next graph and talk about what I have just mentioned. The energy and commodity complex are not going up, but they're certainly showing that there is a certain element of bottom that destroys the narrative of further disinflation coming from energy. So core inflation is not improving and the energy base effect is slowing down. Let's look at the next graph, which is also quite important, which shows us the element that I was talking about just prior, which is the contribution to the US CPI year on year. What we can see is that the energy component has been the driver, and therefore what we need to be is exceedingly worried about a core inflation that is not slowing down but is likely to accelerate in October. Therefore, don't think that governments have all the capacity to spend. Economic, fiscal, and inflationary limit. Keep defending freedom.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.